The next financial crisis might be closer than we think, but you don't have to get caught off guard. In this video, we're going to break down smart, actionable steps you can take now to safeguard your wealth and protect your future. From diversifying your portfolio to strengthening your emergency fund, we'll show you how to stay a step ahead when the markets get shaky. Get ready to take control of your financial future. Today we will talk about preparing for the next financial crisis, what you can do to safeguard your wealth. So before we start, make sure to hit the like button and subscribe to my channel. 1. Why preparing now is so important. One of the greatest misconceptions about financial crises is that their signals will be clear and well announced in advance. The reality is quite different. Market downturns typically come faster and more violently than most people realize. Asset prices can drop by 20% or more within days, liquidity can vanish, and panic selling can exacerbate losses. Furthermore, many people become paralyzed by fear, ignoring their portfolios or making irrational decisions at precisely the worst moment. That's why preparation must be done well in advance, while markets are stable and opportunities for protective strategies are abundant. The financial crisis of 2008, for example, surprised many who were over-leveraged and undiversified. There were signals, a weakening housing market, growing subprime mortgage defaults, but few took protective action in time. The key to protecting your wealth is acting before trouble starts. That means strengthening your portfolio, reducing risk, and securing your financial future while conditions are still relatively calm. 2. Reduce debt and boost your savings. Your financial health starts with your balance sheet. That means you need to lower your debt and increase your cash reserves. During a crisis, income streams can become unreliable. You may lose your job, your business profits may diminish, or your rental income might drop, making it hard to service large amounts of debt. Carrying a heavy debt load during a downturn can be a death sentence for your financial stability. That's why it's crucial to pay off high-interest debt first, credit cards, personal loans, and car payments, and avoid taking on new obligations. Furthermore, consider establishing an emergency fund of at least 6 to 12 months' worth of expenses. That pool of cash will allow you to navigate a temporary income shock without selling assets at a loss or borrowing under unfavorable terms. Ideally, this fund should be kept in a high-yield savings account or a money market fund, something liquid and easily accessible, while still earning a reasonable return. 3. Diversify your assets to reduce risk. Diversification is your best friend when markets become unpredictable. The principle here is simple. You shouldn't put all your financial resources into a single asset class, industry, or geographic market. Instead, you should spread your portfolio across different asset classes, stocks, bonds, real estate, cash, and even alternative assets, to reduce the risk that a downturn in any one area will destroy your portfolio. A well-diversified portfolio typically comprises a mixture of growth assets like stocks, income-generating instruments like bonds, hard assets like real estate or gold, and liquid cash holdings. Furthermore, geographic diversification, owning assets across different countries, can help diminish risk if a financial crisis predominantly impacts a particular market. Ideally, you should aim for diversification that's tailored to your risk tolerance, financial goals, and time horizon. This might be a 60% stocks, 30% bonds, 10% cash portfolio for a young investor, or a more conservative 40% stocks, 40% bonds, 20% cash portfolio for a retiree. 4. Prepare your portfolio for market volatility. Safeguarding your portfolio against a crisis isn't about avoiding all risk. It's about managing risk effectively. That means choosing assets that can perform well or at least retain their value during a downturn. Traditionally, high-quality government bonds, particularly U.S. Treasuries, act as a safe haven in crisis conditions. When stocks fall, bond prices often rise, helping to stabilize portfolios. Gold and other precious metals, meanwhile, have historically acted as a store of value when financial markets become unreliable. Some investors also consider defensive stocks, which typically operate in sectors less affected by economic cycles, such as healthcare, consumer staples, and utilities, to help their portfolios weather downturns. Furthermore, adding instruments like options, puts, or inverse ETFs can act as a form of portfolio insurance, allowing you to profit if markets drop. However, these strategies require careful consideration and expertise and should be implemented judiciously and in small amounts to avoid adding additional risk. 5. Reduce riskier assets and rebalance appropriately. As a crisis looms or signals start to appear, For example, weak economic indicators, flattening yield curve, growing corporate defaults. It may be wise to proactively rebalance your portfolio toward less risky holdings. That could mean selling off speculative stocks, trimming positions in high-risk sectors, and adding more cash, treasuries, or defensive stocks. Importantly, this should be a gradual process, not a panic-selling spree. Ideally, you should follow a clear asset allocation plan, reviewing and rebalancing it regularly, say once or twice a year, or when your holdings move more than 5% from your target weights. Rebalancing lets you sell high and buy low, a discipline that can boost long-term returns and minimize losses in a downturn. Furthermore, consider employing a barbell strategy, a portfolio that holds predominantly low risk and some high-risk assets, which can help you stay exposed to growth while protecting against downside. 6. Develop multiple streams of income. Having multiple income streams is a powerful form of financial protection during a crisis. If you lose your primary paycheck or profits from your business diminish, you'll still have other sources of income to keep you solvent. Ideally, you should aim to develop at least 2 or more income streams. This might be rental income from real estate, dividend payments from stocks, side hustles, freelance income, or profits from a small online venture. The key is diversification here, just as it is for your portfolio. Furthermore, income-producing assets can help you avoid selling at a loss during a downturn, instead of liquidating holdings under pressure. You can rely on ongoing cash flows to cover expenses and service debt. The result is greater financial stability and peace of mind when markets become unpredictable. 7. Develop a crisis plan and stay informed. Your financial preparedness should be supported by a well-thought-out crisis plan, a document that specifies exactly what you will do if markets start falling or financial stress signals appear. Your plan should outline which assets you will sell first, how much cash you want to raise, what defensive positions you will implement, and when you will reassess. Importantly, having a clear plan in place reduces the likelihood of making impulsive decisions when emotions are running high. Furthermore, staying informed is crucial. Follow financial news, economic indicators, and policy decisions, but avoid sensationalism. Your decisions should be driven by facts and a well-prepared strategy, not fear. Monitor indicators like unemployment, bond yield inversions, corporate profits, and bank health to gauge the health of the financial system. 8. Turning crisis into opportunity. Ultimately, a financial crisis, while painful, can be an opportunity for well-prepared investors. Market downturns often result in quality assets trading at deep discounts, allowing you to buy stocks, real estate, or other assets at prices far below their true value. The key is having the financial resources, discipline, and confidence to act when panic selling dominates the market. That's why conserving cash, reducing debt, and diversifying your portfolio are all crucial components of crisis preparedness. Furthermore, a well-prepared portfolio is less prone to permanent capital destruction and more likely to rebound quickly when markets stabilize. So while a financial crisis may seem threatening, it's not necessarily a death knell for your financial future. With careful planning, discipline, and patience, you can navigate the downturn and emerge in a strong, flexible, and opportunity-rich position. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.